Here we will talk briefly about non-sovereign bonds, quasi-government or agency bonds, and supranational bonds. Non-sovereign bonds are bonds issued by states, provinces, cities, municipal authorities. So they are government bonds, but these are not national governments. They are not federal governments. The credit rating of these bonds will be lower than the credit rating of sovereign bonds, and this credit rating actually varies a lot. The credit rating will depend on the collateral, it will depend on the taxing authority of the entity which is issuing the bonds. It will also depend on the other projects that this entity might be doing. And at a high level, the money that is used to pay investors will come either from taxes or some sort of projects. In doing the credit analysis, we have to consider the taxing authority of the entity and the ability to impose taxes for bonds where the funding is coming from projects. These bonds are called revenue bonds, and there obviously we need to evaluate the cash generating ability of the projects. Quasi-government or agency bonds are bonds issued by agencies. You can think of agencies as entities which are established by the government and they are meant to perform a certain function. In the United States, for example, the Federal National Mortgage Association or Fannie Mae is an agency. The bonds issued by this agency would be called agency bonds. Agency bonds generally have low credit risk. The reason is that historically default rates have been very low. Another reason is that many of these agencies are backed by the government. So they have either implicit or explicit government guarantees. In terms of making payments to investors, the money comes from the operations of the agency. Supranational bonds are bonds issued by entities such as the World Bank and the IMF. They are government related in a sense, but not tied to a specific national government. Let's look at example 5 now. Relative to sovereign bonds, non-sovereign bonds with similar characteristics most likely trade at a yield that is lower, same or higher. Remember, non-sovereign bonds will have a higher credit risk and investors will therefore demand a higher yield to compensate for that higher credit risk. So the yield is going to be higher. Bonds issued by a government agency are most likely repaid from the cash flow generated by the agency. So that looks right, but let's look at the other options. Guaranteed by the national government that sponsored the agency. This might be the case, but it is not necessarily the case. So we can put a question mark here. Backed by the taxing power of the national government that sponsored the agency. That is generally not the case. Agency bonds are backed by the cash flows that they generate. So the best answer is A. So far we have talked about the government and government related sector. We now switch gears and talk about the corporate sector. Companies can raise money or borrow money in different ways. One way is to simply borrow money through a bank. So that would be a bank loan. On the next slide, we'll talk about what syndicated paper means. Companies can also borrow by issuing commercial paper, and companies can borrow by issuing commercial notes and bonds. Let's look at bank loans and syndicated loans. A bilateral loan is a loan from a single lender to a single borrower. So if a given company goes to a bank and borrows, that is a bilateral loan. A syndicated loan is a loan from a group of lenders called the syndicate to a single borrower. Very often they will be the lead bank, which then also loops in other banks, and the collective entity that is lending, or the group of banks, they are referred to as the syndicate. A few general points here. Most bilateral and syndicated loans are floating rate loans. The reference rate could be any rate, but generally it is the interbank offer rate, and then there is a spread which is charged over the interbank offer rate. That spread is based on the credit worthiness of the borrower. For highly rated companies, both bilateral and syndicated loans can be more expensive than bonds issued in financial markets. And I'll put this with a caveat. This also depends on the country that we are talking about. In countries where financial markets, capital markets are well developed, this is definitely true. In other countries where capital markets are not that well developed, most companies don't really have much of a choice and will have to rely on bank loans and syndicated loans. Commercial paper is a short-term unsecured promissory note issued in the public market or via a private placement that represents a debt obligation of the issuer. Roughly speaking, this is the corporate equivalent of a T-bill because it is short-term. Commercial paper is a valuable source of flexible, readily available, and relatively low-cost short-term financing. The largest issuers of commercial paper are financial institutions, but some large non-financial companies also issue commercial paper. Commercial paper is often used to raise money for working capital or raise money when there is a high demand for cash. Commercial paper is also a source of bridge financing. What that means is if a company needs money to build a large plant, for example, or needs money for a substantial expansion, and let's say that it will take time to raise sufficient amount of money, then commercial paper can be used to raise money in the interim. So it is in a sense a bridge till the time that money can be raised through, let's say, a large scale bond issue. I made a comparison between commercial paper and T-bills, where T-bills are short-term government instruments. The yield on commercial paper will be greater than the yield on short-term government bonds. The reason is that commercial paper will come with some credit risk. Since we have a corporate entity issuing commercial paper, there is a risk of default. The risk will vary from entity to entity, but there is a risk. So because of that credit risk, investors will demand a higher yield when they invest in commercial paper. There is also liquidity risk. If an investor buys commercial paper and is not able to easily sell that paper in the secondary market, then there is a lack of liquidity and investors will demand a premium or a higher yield because of that lack of liquidity. I have mentioned the fact that there is credit risk associated with commercial paper, and in fact the three major rating agencies do issue credit ratings for commercial paper, and you don't need to remember everything on this excerpt, but here are the sorts of ratings that are assigned. Commercial paper which has a rating of adequate or better is generally called prime paper, and this is considered investment grade. Rating agencies generally require that issuers of commercial paper do secure backup lines of credit because this helps reduce credit risk. Another term that you need to know is the rolling over of the paper. What this means is that if we have a 9-month commercial paper, after 9 months, when money needs to be paid back to the investor, then the issuer might issue another commercial paper and use the issue proceeds to make this payment. When that happens, we say that we are rolling over the paper, or the issuer is rolling over the paper. Commercial paper has traditionally been used by larger, more stable companies, and also historically the default rate has been quite low for commercial paper. We now look at the difference between US commercial paper and Euro commercial paper. The differences are highlighted here. I will emphasize the most important difference. US commercial paper charges interest on a discount basis. This is analogous to what you see with T-bills, whereas Euro commercial paper charges interest based on a add-on basis. This is what you will see with LIBOR-based loans. This distinction is important, and it is something that you also see in other parts of the course. But very simplistically, a discount basis means that we have a rate which is quoted as a discount relative to par value. So let's say that we have a 180-day US commercial paper and the par value is 100. If this commercial paper is issued for 95, then the interest amount is 5, and to calculate the rate, we do 5 divided by 100, which is the par value, and then we annualize. So note that the interest is being compared with the final par value. Whereas with Euro commercial paper, if the principal amount is 100, then the interest will be based on the loan amount. Here the loan amount effectively is 95. So that is the high level distinction. This is something that you see in more detail in other parts of the curriculum. But if you are confused about this, then you can take a look at Exhibit 9 in the curriculum, which runs through some calculations to highlight the difference. We now come to corporate notes and bonds. In terms of maturities, there is no formal definition of short-term, medium-term, long-term. But generally speaking, if a security has a maturity of greater than 12 years, then it is referred to as a bond. And if the security has a maturity of less than 12 years, then it is referred to as a note. In the less than 12-year category, if a security has a maturity of less than 5 years, then it is often referred to as a short-term note. And between 5 and 12 years would be intermediate term. You might also hear this term, medium-term note, or MTN. This is a misnomer. It doesn't actually mean that the maturity is between 5 to 12 years. The most important feature, or the defining feature of a medium-term note, is that it is offered continuously to investors through an agent. And very often these have shelf registrations. Because of this, the underwriting fee is relatively low, which makes MTNs cost effective. Next, we talk about coupon payment structures, and we have seen this over and over. We can have corporate bonds which are zero coupon bonds, so they have no coupon. We can have fixed rate coupons, we can have floating rate notes, and as we saw in the previous reading, we can also have the concept of payment in kind. We can have credit linked coupon bonds. I'll not explain each of these terms because we have already covered this concept. Principal repayment structures. Here we can have what is called a serial maturity structure or a term maturity structure. In a serial maturity structure, the maturity dates are spread out during the bond's life. With a term maturity structure, the principal amount is paid off in a lump sum at maturity. Some bonds have a sinking fund provision or a sinking fund arrangement which involves paying off a certain percentage of the principal earlier, and that helps reduce credit risk. Corporate bonds do have credit risk, and as investors, we need to understand the asset or collateral backing a given bond or fixed income security. We also need to understand the seniority structure. Corporate bonds might have contingency provisions such as call provisions, put provisions, or conversion provisions. And as investors, we need to understand these provisions because some of these provisions benefit us as investors and others benefit the issuer. Issuance, trading, and settlement. Settlement now happens electronically across the globe. Most bonds are traded through dealers who make a market, which means that the dealer stands ready to buy and sell bonds. Investors therefore interact with dealers. Sometimes dealers might interact with other dealers. So this clearly is an over-the-counter market. The settlement typically is T+3 in most jurisdictions, though it can be somewhat longer in other jurisdictions. Bond prices are generally quoted in a basis points format. Now let's take a look at example 6. A loan made by a group of banks to a private company is most likely a syndicated loan. When we have a group of banks, that means it is a syndicated loan. A bilateral loan would be one where there is just one bank involved. Which of the following statements relating to commercial paper is most accurate? Companies issue commercial paper only for funding working capital. Because of this only, this is not true. Only as an interim source of financing, again because of this only, B is not true. Both for funding working capital and as an interim source of funding, this is true. Remember, interim source of funding, this is also referred to as bridge financing. Maturities of euro commercial paper range from, and the correct answer here is B, just something you need to remember. I did show you an exhibit but did not highlight this point, but you can learn it now. A bond issue that has a stated number of bonds that mature and are paid off each year before the final maturity most likely has a... Here term maturity is clearly not the right answer because with term maturity the amount is paid off in lump sum at the end. So the choice is between B and C, and I did not explicitly mention the difference in detail earlier, so let's look at the difference over here. When we say serial maturity, what that means is that bonds are being retired over a period of time. With serial maturity, it is defined in the beginning which bond will be retired at what stage. So when the holder of a bond or when an investor buys a particular bond where there is serial maturity, the investor will know when that bond will mature. In other words, when will he get his principal back. Whereas with a sinking fund arrangement, there is uncertainty because the bonds which are retired are selected through a lottery. If we look at the way this question is worded, the best answer is B. And what I would want you to do here is read the explanation in the curriculum because it illustrates the difference between serial maturity and sinking fund arrangement very well.